We're going to talk about the real estate angle here. Joining us live on set is David Steinbach. He is global CIO of Hines, which is one of the largest private real estate investment firms. David, great to speak with you. So there's the chips that go into the data centers. We won't ask you about that, but we want to talk to you about the actual physical data centers, the facilities housing the IT infrastructure, the servers, networking equipment. From where you sit, do you see any kind of immediate cause and effect between NVIDIA's commentary on demand for its chips with the supply of data center facilities?
So great question, and we've been done data centers for a long time, and it's interesting to see how the space has evolved. Years ago, when we were doing them, the customer were mainly the banks, and the scarce resource was mainly the building spec. Today, the customers are mainly the hyperscalers, and the scarce resource is energy, as we all know. And so that real shift has affected pricing. It's affected where you can do data centers. It affects some of the supply. But the constraint in the system right now is not the physical real estate itself, it's power and it's access to it. And that's really the thing driving pricing for where you can put the data centers.
So where does that leave certain markets? Which markets are in a better position to house some of those data centers versus those that shouldn't be considered?
It really depends on where you are in the world. So in Europe, there's a different dynamic. The way the utilities are regulated and power access is given is very different. So areas such as in France, UK, Ireland have all had different elements. More interest on the continent now of Europe versus before it was a bit more focused on Ireland and UK. Here in the United States, the grids are much more distributed in terms of how power is accessed. Places like Texas have been very aggressive in trying to get power and be very easy to get power interconnects to. So it's again very, very location dependent.
Bottoms up.
I am curious about what you are seeing in terms of pricing. And I think the last time we had you on, you talked a little bit about how some of the pricing that you've seen in this space is, at least from an investor's perspective, your perspective, not necessarily attractive.
Well, I'd say the last 24 months, I think that there was a significant focus and drive by the hyperscalers to get access. They were trying to nail down locations, try to nail down access, because they knew, I think they could see the constraints coming. And so there was a very much almost a going on offense to be ready for a game that was going to be underway. That created a dynamic of pricing that got pretty aggressive. And that we have felt pull back some, but that doesn't mean that the space is, I'm not in no way, shape, form negative on the space. It just means some of that, maybe that excitement has waned a little bit, but that's probably a good thing. Yeah. Probably does mean that actually, given I think we all believe in the long-term potential of this and the amount that has to be built, any pullback actually means you lean in. And that actually means there probably are some interesting opportunities.
So it's interesting. I mean, you mentioned, you kind of used the word long-term, and this is a long-term play. And as a real estate investor, I do have to ask you just about the interest rate environment, particularly at a time when the market seems to be pricing in the idea of a long-term drop in rates, or at least a more dovish central bank that maybe, I would think, potentially be beneficial to real estate investments. What are your expectations?
I think that if the Fed does drop rates a little bit, say 25 basis points, I think in light of where we've been, which at one point was a 500 basis point increase in rates, those are just small incremental changes. The bigger thing to look at for me is the longer tail of interest rate expectations and where we think inflation interest rates will be in 5 or 10 years, because when you do a real estate project, you underwrite for that duration. And so thinking about that is really important. The thing I think is happening in the market right now, though, is because of interest rate pricing, and maybe some rates coming in will help this, new development, it's hard to make it pencil because investors are usually looking for a spread between your build to versus buy to rates of return. About 200 basis point spread is common. And so because we're not seeing that right now, the market is not developing and we're not bringing in new supply like we should. That makes it a fantastic time to be acquiring because with time, rent growth and other demand pressures will come to the market and make those acquisitions you're doing today look very smart. And it will be time to build once rental rates go up, but we're in this kind of in-between space right now.
How long does it take for that that to happen? I mean, you're saying that there's going to be this lull, this lag period, but I'm curious whether that's going to be months or years.
Well, in some markets, we're already seeing the rent growth come through. The U.S. is about 2.5 million houses short, and in some markets, we're seeing some rent growth in multifamily. Other markets, and I'll say even the best of best office projects where there's a lack of new supply, lack of quality product, we're seeing some rent growth. So it depends on where. Some markets it's happening today. Other markets I would expect it in the coming 12 months.
I appreciate the long-term view that you take on here when you're considering these projects, 5 to 10 years out. Given that there's a lot of concern about inflation over the longer term, I'm wondering what kind of scenario you're using as an assumption. Are we talking about like a light stagflation kind of environment here?
It is starting to look like that is likely the scenario that we're looking at, which is more stagflation. We've done some research in our team to look back at other times like that, and you go back to the 1960s and 70s to see some similar dynamics of what we're seeing today. And in that, you see rent growth come through. And that's a little bit counterintuitive. People think back on the 70s and didn't think it was viewed as kind of a flat time. In real estate, actually, rent growth came through. We've got the evidence to show that. So that does inform how you want to underwrite deals today, and really looking to rent growth as a driver of value creation.
I do want to circle this back to NVIDIA and AI, not so much from the AI trade, but this idea of how the geography in this nation has shifted. We've talked a lot about how, down south, we've seen a lot more migration down there, which of course has helped your real estate businesses in those areas. There's been also a lot of talk about how AI is also reshaping that geography. A lot more companies located outside of Silicon Valley, outside of New York. And I am curious whether you see that tech trend, whether it's data centers or the physical consumer products, or even just the incorporation of companies, aiding that migration to the non-traditional areas.
Well, I do think San Francisco is going to be a beneficiary, and I think we're already seeing some of that on the real estate side, and we're making acquisitions today in the Bay Area, and I think there's some interesting buys there. But I do think when you look at the economy broadly and think about the drivers the next 5 to 10 years, I mean, data, AI, energy, space, I mean, there's a handful of things that feel like they're going to have a disproportionate impact, and chasing those quarters of demand, wherever they might be, with the Space Coast in Florida, things happening in Texas. I mean, there are some real new quarters of demand that are coming up, and I think it's important for investors to stay ahead of that and be thinking about what's going to drive the next economy. Yeah, and we didn't get a chance to talk about it on the show, but that SpaceX launch the other day, a big milestone there. David has his finger on the pulse of all of that as global CIO over at Hines.